If you rely only on official headlines, you're being told a reassuring story. You're told the labor market is cooling, not collapsing. You're told job growth continues. You're told unemployment remains historically low. On paper, everything looks manageable. But what happens when the way we measure work no longer captures how work actually disappears? Because right now, millions of Americans are losing income without ever being counted as unemployed. Not through mass firings with cameras outside office buildings, not through dramatic pink slips, but through quieter mechanisms that don't trigger headlines or statistics. Hours being reduced, contracts quietly not renewed, freelance clients disappearing, temporary roles ending with no replacement, hiring freezes that close doors without announcing layoffs, workers technically still employed, but earning far less than before. These losses rarely show up in monthly jobs reports. Government employment surveys are designed to track payroll jobs and formal layoffs. They are far less effective at capturing reductions in hours, income erosion, contract work disappearing, or people who stop looking because repeated rejections convince them nothing is available. Economists openly acknowledge these blind spots, which means the official picture can look stable even while financial stress inside households keeps intensifying. You do see large corporate layoff announcements, tens of thousands at major companies. Those numbers feel enormous, but they represent only a fraction of how workforce contraction now happens. Most cuts today occur through what companies call attrition, restructuring, reorganization, and efficiency initiatives. Language that avoids the word layoff, avoids regulatory scrutiny, and avoids alarming investors. At the same time, corporate profits across many sectors remain strong, cash reserves remain historically high, and markets frequently reward cost-cutting with rising share prices. Investors interpret lower labor expenses as higher future margins. So eliminating jobs is no longer treated as a warning sign. It is treated as a signal of discipline. While this is happening, the price of everyday life has risen dramatically over the past 5 years. Housing costs are up sharply in most metropolitan areas. Grocery prices remain far above pre-pandemic levels. Insurance premiums, utilities, and medical out-of-pocket costs continue to climb. Even as inflation reports show slowing price growth, prices themselves are still much higher than they were. Slower increases do not mean lower costs. Wages, meanwhile, have risen far more slowly than essential expenses for many households, especially after accounting for taxes, healthcare deductions, and housing. So people may technically be working, but their purchasing power keeps shrinking. That gap between what the economy reports and what households experience is the most important story in America right now. Because when millions of people are earning less, working more, and falling further behind, while the system insists things are fine, that isn't a healthy labor market. It's a labor market that no longer tells the truth about itself. And once you start looking beyond the surface numbers, a disturbing pattern becomes impossible to ignore. The modern economy isn't simply failing to protect workers. It is quietly learning how to operate without them. If you rely only on official headlines, you're being told a reassuring story. You're told the labor market is cooling, not collapsing. You're told job growth continues. You're told unemployment remains historically low. On paper, everything looks manageable. But what happens when the way we measure work no longer captures how work actually disappears? Because right now, millions of Americans are losing income without ever being counted as unemployed. Not through mass firings with cameras outside office buildings, not through dramatic pink slips, but through quieter mechanisms that don't trigger headlines or statistics. Hours being reduced, contracts quietly not renewed, freelance clients disappearing, temporary roles ending with no replacement, hiring freezes that close doors without announcing layoffs, workers technically still employed, but earning far less than before. These losses rarely show up in monthly jobs reports. Government employment surveys are designed to track payroll jobs and formal layoffs. They are far less effective at capturing reductions in hours, income erosion, contract work disappearing, or people who stop looking because repeated rejections convince them nothing is available. Economists openly acknowledge these blind spots, which means the official picture can look stable even while financial stress inside households keeps intensifying. You do see large corporate layoff announcements, tens of thousands at major companies. Those numbers feel enormous, but they represent only a fraction of how workforce contraction now happens. Most cuts today occur through what companies call attrition, restructuring, reorganization, and efficiency initiatives. Language that avoids the word layoff, avoids regulatory scrutiny, and avoids alarming investors. At the same time, corporate profits across many sectors remain strong. Cash reserves remain historically high, and markets frequently reward cost-cutting with rising share prices. Investors interpret lower labor expenses as higher future margins. So eliminating jobs is no longer treated as a warning sign. It is treated as a signal of discipline. While this is happening, the price of everyday life has risen dramatically over the past 5 years. Housing costs are up sharply in most metropolitan areas. Grocery prices remain far above pre-pandemic levels. Insurance premiums, utilities, and medical out-of-pocket costs continue to climb. Even as inflation reports show slowing price growth, prices themselves are still much higher than they were. Slower increases do not mean lower costs. Wages, meanwhile, have risen far more slowly than essential expenses for many households, especially after accounting for taxes, healthcare deductions, and housing. So people may technically be working, but their purchasing power keeps shrinking. That gap between what the economy reports and what households experience is the most important story in America right now. Because when millions of people are earning less, working more, and falling further behind, while the system insists things are fine, that isn't a healthy labor market. It's a labor market that no longer tells the truth about itself. And once you start looking beyond the surface numbers, a disturbing pattern becomes impossible to ignore. The modern economy isn't simply failing to protect workers. It is quietly learning how to operate without them.
There was a time when experience was insurance. The longer you stayed with a company, the more secure you became. Institutional knowledge mattered. Mentorship mattered. Climbing the internal ladder was the reward for loyalty. That structure didn't just provide income. It created predictability, a visible path forward. That structure is thinning out. From a balance sheet perspective, experienced employees are expensive. They command higher salaries, they receive stronger benefit packages, they accumulate retirement contributions. In industries where labor represents a major share of operating costs, reducing a handful of senior salaries can produce the same short-term savings as cutting a much larger group of entry-level workers. When financial targets tighten, spreadsheets often point to the middle first. This doesn't mean every company is systematically targeting older workers. But federal age discrimination lawsuits in recent years, including cases involving hiring software and screening tools, reveal how automated filtering systems can disproportionately impact applicants over 40. Algorithms are trained on cost, tenure, and prior salary data. Those variables tend to correlate with age. When optimization models prioritize lowering compensation expenses, experienced candidates can quietly fall out of the pipeline. It's not always deliberate bias. Often, it's financial logic translated into code. And once mid-career roles shrink, something structural begins to happen inside companies. The internal ladder starts losing its rungs. Fewer mid-level managers, fewer senior specialists, fewer long-tenured mentors. Entry-level employees have fewer pathways upward. Promotions slow. Skill development becomes fragmented. Over time, organizations can become top-heavy at the executive layer and bottom-heavy at the hourly layer, with a thinner middle. That isn't just a workforce issue. It's an economic one. The American middle class has historically been built on stable mid-career income. Remove that stability, and the broader consumer base weakens. At the same time, young graduates are entering a labor market that looks very different from the one their parents faced. College attainment is higher than ever. But degree saturation means credentials alone no longer guarantee opportunity. Entry-level professional openings attract hundreds, sometimes thousands, of applicants. Hiring cycles stretch longer. Internships replace permanent roles. Contract positions substitute for staff roles. Meanwhile, student debt obligations remain fixed. Housing costs have risen sharply across much of the country. Insurance premiums, transportation expenses, and healthcare out-of-pocket costs have climbed significantly over the last 5 years. Even when inflation rates cool, price levels remain elevated. Slower increases do not reverse previous spikes, so you have two pressure points operating simultaneously. Experienced workers face cost-based optimization. Younger workers face credential oversupply and limited entry slots. The middle compresses. Now add another layer: technological anticipation. Artificial intelligence is advancing rapidly, but in most industries it is not yet capable of fully replacing complex human roles without supervision. However, companies are reorganizing today based on expectations of future automation. If leadership believes certain functions may be automated within 5 or 10 years, reducing headcount now can be framed as modernization rather than downsizing. This narrative is powerful. We're investing in AI. We're becoming more efficient. We're future-proofing operations. Those statements are forward-looking and innovative. They sound better than "we're cutting payroll to improve margins." In reality, in many sectors, AI tools still require significant human oversight. Customer service systems escalate to people. Automated logistics systems depend on human troubleshooting. Financial software requires compliance review. But the perception of impending automation alters workforce decisions before full capability exists. The psychological effect on workers is profound. When you believe a machine may eventually replace your role, bargaining power weakens. Employees become more cautious about negotiating salary, more hesitant to demand flexibility, more willing to accept reduced hours or contract status. And this is where algorithmic management begins to reshape compensation itself. Large employers increasingly use software to manage scheduling, productivity tracking, and compensation modeling. Dynamic pricing systems are common in gig platforms. Surge pricing fluctuates based on supply and demand. But similar logic is spreading into traditional sectors. When labor supply rises in a region, wage growth slows. When applications flood a posting, salary bands tighten. When scheduling software detects flexibility, hours may be redistributed in smaller increments to avoid triggering benefit thresholds. These systems are designed to optimize costs. They are not designed to evaluate fairness. Research in labor economics has shown that pay transparency restrictions, salary history questions, and algorithmic matching can anchor future wages to past compensation. Even as some states have banned salary history inquiries, historical earnings data still influences algorithmic models in many systems. Once someone begins at a lower pay band, climbing out becomes statistically difficult. It's not a conspiracy, it's compounding math. If you combine cost-optimized staffing, thinner mid-career layers, algorithmic scheduling, and elevated living expenses, you create an environment where many workers technically remain employed, but feel financially unstable. And that instability feeds directly into behavior. Households reduce discretionary spending. Savings rates fluctuate. Credit card balances rise. Federal Reserve data has shown increasing credit utilization in recent years, alongside interest rates above 20% on many cards. When borrowing becomes expensive and wages lag behind essential expenses, second jobs become more common. This is why the rise in multiple job holders matters. It's not simply ambition. For many, it's compensation for income volatility elsewhere. The labor market, viewed through official unemployment percentages, can look resilient, but when you zoom into job quality, wage growth relative to living costs, and workforce structure, a different narrative emerges. Not collapse in a dramatic sense, but compression. And compression, sustained long enough, reshapes an entire economy from the inside. If you'd like to continue, the next section will examine the cost of living divergence in more detail, how price levels, housing dynamics, insurance spikes, and service inflation have outpaced wage growth for many households, and why that gap drives the sense that the system isn't working. For most households, the stress doesn't begin with unemployment. It begins at the checkout counter. It begins when the rent renewal notice arrives. It begins when the insurance premium updates. The official inflation rate may fall from 9% to 3%, but that only measures the speed at which prices are rising, not the level they've already reached. And for millions of Americans, the level is what matters. Housing is the clearest example. Since 2002, rents in many metropolitan areas surged dramatically, with national indexes showing cumulative increases that, in some regions, exceeded 30 or even 40% before stabilizing. Mortgage rates, meanwhile, more than doubled compared to pandemic-era lows, pushing monthly payments sharply higher for new buyers. Even where home prices cooled slightly, financing costs kept total housing expenses elevated. Shelter alone now consumes 30% or more of income for a significant share of renters, and far more in high-cost cities. Then there's food. Grocery prices spiked heavily during the supply chain disruptions of 2001 and 2022. While the pace of increase has slowed, prices have not returned to pre-pandemic levels. Many staples remain 20 to 30% higher than they were 5 years ago. Shrinkflation, smaller packages at similar prices, makes the real increase less visible but still tangible. For households spending 15% or more of income on food, those changes accumulate quickly. Insurance costs have surged even more aggressively in certain regions. Auto insurance premiums rose sharply over the past 2 years, in part due to higher vehicle repair costs and accident severity. Homeowners insurance premiums climbed in states facing climate-related risks. Health insurance deductibles and out-of-pocket costs have trended upward over the past decade, even when employer-sponsored coverage remains intact. Utilities and energy bills have fluctuated with global markets, but remain volatile. When you layer these together, housing, food, insurance, utilities, transportation, healthcare, the lived experience of inflation can feel far higher than the headline number suggests, because households don't consume a theoretical basket of goods. They consume necessities. Meanwhile, wage growth has been uneven. Lower-income workers did see faster nominal wage growth in the immediate post-pandemic period, but when adjusted for cumulative price increases, real purchasing power gains have been modest and inconsistent. For many middle-income households, especially those locked into fixed salaries, raises have lagged behind cumulative living cost increases. The result is a quiet squeeze. When essential expenses rise faster than earnings, something has to adjust. Savings fall first. During the pandemic, households accumulated excess savings due to stimulus payments and reduced spending opportunities. But Federal Reserve data shows much of that buffer has been drawn down. Credit card balances have climbed to record levels in nominal terms. Delinquency rates have ticked upward from historically low levels. This is not a collapse, it is a tightening. And tightening changes behavior. When people feel financially cornered, they delay large purchases. They postpone home upgrades. They cut back on discretionary services. They reduce travel. Businesses that rely on middle-class spending feel the slowdown first. Retail hiring weakens. Seasonal positions shrink. Temporary labor pools thin out. Historically, holiday hiring acted as a pressure valve. Retailers would ramp up staff between October and December to meet demand. That surge provided short-term income opportunities for students, part-time workers, and households trying to close year-end financial gaps. But in recent cycles, hiring projections have been more cautious. Retailers are investing in inventory control, automation, and tighter staffing models. Application volumes are high, but openings are fewer than in peak expansion years. This matters because seasonal work once functioned as a financial cushion. Without it, households relying on temporary boosts have fewer options. Now combine everything. Mid-career compression, entry-level saturation, algorithmic cost management, elevated living expenses, rising credit costs, thinner seasonal hiring. Individually, none of these signals prove collapse. Together, they describe a labor market under structural pressure. And when pressure builds slowly, it often goes unnoticed until something shifts more visibly. The psychological divide widens first. People begin to feel that the economy they're told exists is not the one they're living in. Trust in data weakens. Trust in institutions erodes. Risk tolerance declines. Long-term planning shrinks to short-term survival. That is the quiet transformation underway. Not a dramatic crash, not a single breaking point, but a gradual redefinition of what work provides, from stability and upward mobility to volatility and maintenance. And once work no longer guarantees security, the entire social contract begins to feel negotiable. If you'd like to continue, the final segment will connect all of this. What this structural shift means for the future of labor, corporate strategy, and the American middle class, and whether this trajectory is reversible. When you step back and connect all of these threads, the picture that emerges is not one of sudden collapse, but of structural redesign. Work in America is being recalibrated. Corporations are operating in a system that rewards margin expansion, quarterly performance, and cost discipline. Investors respond quickly to efficiency. Executive compensation is often tied directly to stock performance. Labor, as one of the largest recurring expenses, becomes the most flexible lever available. Reduce headcount, slow hiring, restructure teams, automate selectively, outsource non-core functions. Each move improves the balance sheet in the short term. At the same time, technological advancement, especially in data analytics and automation, gives companies more precision. They can forecast demand more tightly, schedule labor more dynamically, model compensation bands more aggressively. None of this is inherently malicious. It is optimization. But optimization applied narrowly to cost can gradually hollow out stability. Workers feel this shift before the data fully reflects it. They feel it when internal roles disappear and are replaced with contract arrangements. They feel it when promotions stall because mid-level layers shrink. They feel it when hiring freezes extend for months while workloads remain. They feel it when salary negotiations become rigid because compensation software has already determined the acceptable band. And they feel it most clearly when expenses rise faster than income. The traditional promise of the American labor system was straightforward. Work steadily, gain experience, climb incrementally, and your standard of living improves over time. That promise depended on three pillars: rising productivity, translating into wage growth, a stable middle tier of employment, and living costs that did not outpace earnings for extended periods. Each of those pillars is under strain. Productivity gains in recent decades have not translated proportionally into median wage growth. Mid-career roles face compression from both automation and cost rationalization. Housing, healthcare, and education have grown more expensive relative to income. None of this means the system is irreparable. Economic structures evolve. Policy shifts. Markets adjust. Labor shortages in certain sectors can restore bargaining power. Technological adoption can create new categories of work. Demographic shifts can rebalance supply and demand. But ignoring the structural pressure would be a mistake. Because when a large share of the workforce feels that stability is slipping, even if they remain technically employed, behavior changes in ways that ripple outward. Consumption patterns alter. Family formation decisions shift. Geographic mobility slows. Political priorities harden. Social trust weakens, and markets ultimately depend on confidence as much as cash flow. The most important takeaway isn't that the labor market is collapsing. It's that the definition of employment strength has narrowed. Low unemployment alone does not guarantee upward mobility. A rising stock market does not automatically signal broad-based prosperity. The real question isn't whether jobs exist. It's whether those jobs sustain a durable middle class. If corporations continue optimizing primarily for short-term margin expansion, the pressure on wage growth and workforce depth will persist. If policymakers rely solely on headline unemployment rates, underlying fragility may remain underestimated. And if households continue absorbing higher essential costs without corresponding income growth, the financial cushion that once stabilized downturns becomes thinner. The transformation is quiet. That's why it's powerful. It doesn't arrive as a single crisis moment. It unfolds through incremental decisions, in boardrooms, in software models, in compensation committees, in pricing strategies. Each step individually rational, collectively reshaping the relationship between work and security. The American worker isn't disappearing overnight, but the guarantees that once defined the American job are, and the future of the economy will depend on whether that shift is acknowledged and addressed before compression turns into something far harder to unwind.